The crypto market has significantly dropped in the last week and people are panicking. And the worst part is that some people could still be sitting on a large tax bill this year, even though their total portfolio could end up in a loss. Let me explain why in today's video. Hello everyone, my name is Ethan Rushock and welcome to today's video where I'm going to be talking to you about the crypto market dropping and what that means from a tax point of view. And I'm going to talk to you about a little terminology I've made up, which is the crypto tax trap. And it's something that occurred in 2017/2018. And I can see it happening to some people again here in 2021. Now I always stress this isn't investment or tax advice. You need to do more research because there's more that goes into a decision when it comes to buying or selling an asset than just the tax benefits. So I'll go through what the crypto tax trap is. So what this is when we have a crypto market that's doing really well, and this has happened obviously in the 2021 financial year, and a lot of people are sitting on a lot of gains. So they've made a lot of gains over the last 6 to 12 months, and therefore quite often, because the way crypto works, people have traded through these gains. So they may have moved assets from say Bitcoin to Ethereum. So they've realized gains because that's a taxable event. So to have a fully understanding of that, make sure you check out my video I've done on how does tax work on cryptocurrencies. But the real basics of it is that anytime you pretty much sell an asset, and that doesn't matter if it's moving it from one coin to another, that will create a taxable event. So you're going to have realized gains if you've done that through the year. Obviously, therefore, if your portfolio significantly increased and you've been moving assets, not just holding them, this means that you're going to have a significant amount of realized gains during this financial year. So this is very similar to what happened in the 17/18 financial year, where the market grew significantly, probably through from July up until December, and then we had a market crash in January 2018, and this obviously could play out again this year, where we've had a significant rise up until May, and then we've had a bit of a crash here in middle to late May, and we're obviously not sure what's going to happen in June, but we could see a significant crash. So what happens here, we're sitting on significant realized gains, and we may have some still unrealized, but then we start to sit on significant unrealized losses because our portfolio has dropped in value, but we may not have sold those assets. We may want to hold them through the crash, and therefore they're unrealized. So the reason this causes an issue is because we've got realized gains and they're taxable, and we've got unrealized losses, but they're not able to be offset against those realized gains until they're realized. So I will have some examples soon, but this could cause some significant issues where your portfolio could be in a loss position overall at current market values, but you might have some realized gains that you're actually going to have to pay tax on, even though you've got those losses because they haven't been realized. And this is where it really comes into that tax isn't the only reason to make decisions, because selling at a loss may not be what's best for you. So you need to make sure you're doing your research into that and weighing up these different options, but it's something I want to make people aware of. So the best way to look at that is through an example. So I'll bring up this example here. So say you may have done really well in crypto this year and you've got $40,000 of realized gains. And so they may be through, like I said before, trading Bitcoin through to Ethereum and maybe going into some altcoins. So you've moved some assets around, therefore they've created taxable events. But obviously the market's now dropped and you've got now $50,000 of unrealized losses. So if we look at that position, you're actually in a loss position overall. You're actually 10K down on what your initial investment might have been, but along the way you've realized some gains and you've got some unrealized losses. So you're going to have to pay tax on those $40,000 of gains because they're going to be subject to capital gains tax, and that will be assessed through your tax return, and those losses won't be able to be utilized because they're not realized losses. So you can only utilize a loss once it's realized as an investor. There are different rules if you're running a business of trading, but I'm just talking about people that are investors today. So as you can see, suddenly you're up for paying tax, even though you're going, oh, my portfolio's in a loss. So now you've got to potentially sell assets in the next financial year to get that money to pay that tax bill. So then you might realize some of those losses in the next financial year, but they weren't able to help you in this financial year. So I'll go through a second example here to show you what might happen if you had realized some of those losses. So in this situation, we'll go the same as in the example one. So we've got $40,000 of gains, but this time we've got $30,000 of losses that have been realized. So we might still have the same losses overall, but some of these have actually now been realized. So now suddenly we can offset those losses against those gains, and suddenly we're only going to pay tax on maybe $10,000 here in this situation. So even though you might still be in a loss position overall in this situation as per example one, but you'll realize some of those losses, so therefore the tax you're going to be paying will be significantly less. Now, this is obviously going to depend on your overall situation, whether you've got other assets that may be subject to capital gains or capital losses, or what your plans are in the future. So this is where a lot of people got caught out in 17-18, is that they had significant gains during that financial year that were realised. Their portfolio had dropped, but they wanted to hold through that, so there was nothing wrong with that. But then they got a tax bill for the 17-18 year, and the portfolio had continued to drop, and they go, you know what, I just want to get out of crypto, I don't want to invest. So sold off all those assets in 18-19, realised the losses then, but have no plan of re-entering the market anytime soon, and therefore those losses aren't being utilised. They're just going to roll forward, but they may never want to invest again, or may never buy property, may never have an asset that's subject to capital gains in the future, and therefore those losses won't be utilised. So this quite often happens when a market crashes, people panic and they go, no, I don't want to touch that asset class again, or I may not want to touch any kind of investment assets again. So it's all about thinking about what's your future prospects, and also think about how you value your investments, what your plan is with that, and then tying it all in together to see what would be most beneficial for you. There is something called wash sales, so I've spoken about them previously briefly, but maybe do a bit of a search on that to see whether that would be subject to you, because you don't want to be in the position where you realise some losses, but realise you've annoyed the ATO there and you've gone against some tax laws. So it all comes down to the timing of sales is really vital under the way our capital gain system works. And a part of that is having a good understanding of where you're currently at. So I've spoken about it in a previous video. I'll link it up here about Coinly and coin tracking. So have a look into those softwares because they'll allow you to see where you're currently at from a gains point of view. So you may be able to do some more calculations then on, okay, should I realise some losses? Or maybe if you're in a good position, you might go, okay, it's a good time to realise some gains because I've had some losses earlier through the year. So I think having a good understanding of where you're at is really important when it comes to saving tax. But as I said, tax isn't everything when it comes to making investment decisions. So you want to weigh up all the different areas in your investment decision, but tax is definitely going to be one of those things you need to consider. I hope that video has been valuable to you. Make sure you hit that like button, leave a comment down below, hit the subscribe button, and I'll see you again on the next video.